Joins us now to talk about the big Fed event that's finally out of the way. Adrian, good morning and greetings of the season to you. Finally, that Fed event has come and gone and we are back to worrying about our own domestic issues. How do you see year 2016 for Indian equities?
Yes, I mean, it's somewhat depressing how much of my life I've spent talking about the Fed liftoff. And really, who cares? Hey?
It's as depressing for you as it is for us, I must tell you that.
Okay, so I think it psychologically is important that it was a popular reason to procrastinate. I'm not going to move into EM. I'm not going to buy India until the Fed moves. I think we've got some reasonably clear direction from the Fed. It seems to be in line with our base case, which is a quarter of a percentage point each quarter in 2016. And the market's absolutely taking that in its stride. So what we're going to focus on now is capital flows. And we have seen some encouraging data. It was notable that we were seeing good inflows into, say, Indonesian bonds in the last month. So a reversal of some of the trends that we were seeing after the renminbi move. But you're absolutely right. You know, the focus now is going to be on domestic issues. And I think the key domestic issue for India is when does the Reserve Bank feel comfortable to start easing policy? And the key problem for the Indian industrial sector is that its inflation rate is -4 if you look at WPI, which means real interest rates are 10%. And when they're that high, you're not going to get any capex in India.
So how would you look at just getting the trading question out of the way? We saw a minor amount of green in several emerging markets. Is this just short covering after the event, and thereafter emerging markets will continue to be an unloved asset class?
Look, I think the key is going to be investors' confidence that emerging market equities can deliver some earnings growth. 2015 was another year in which the overall EPS integer for EM fell. I'm reasonably confident looking into next year. It's partly because there's been a major change in the index. So if you look at EM, 4 countries account for 60%, those 4 countries being China, Korea, Taiwan, and India. We are comfortable that you will get earnings growth from those markets. In the case of China, with the addition of ADRs, you've got a very growth, new economy bias benchmark where we do believe there will be quite healthy earnings growth. The old economy is underrepresented in the benchmark, which is good news, with materials at just 1%. So I would strongly recommend to investors that they are adding to emerging market risk, but with a focus on emerging Asia as opposed to Latin America or to the CEMEA region.
Okay, but you know, that's about emerging market equities. But as a whole, how do you focus on asset allocation at a time like this, Adrian? Because, you know, in 2015, a lot of people were torn between fixed income and equities because of the rate cuts. You could even get 10 to 11% in many of the fixed income funds as well. Is there still a big case to get into equities versus fixed income in 2016?
Wow. Look, I think people are quite nervous about global equities. If you look at some of the commentary coming out of our global strategists, our US strategists, you know, you've got an issue with PE multiples being elevated and interest rates are rising. And normally an increase in interest rates, an increase in discount rates is not helpful for pushing PE multiples higher. It'll typically push them lower. So I think there's an issue with we don't particularly like bonds and we don't particularly like equities. And if you're trying to get a higher return on those bonds and you're going outside investment grade, well, there's a lot of stress in the high yield market at this point in time. And that actually might be good news for emerging markets, somewhat perversely, because the yield on emerging market dollar debt is attractive. And I think that will be seeing some inflows as people look for an additional yield, but perhaps with a lower risk than they're going to find in the high yield space in the United States.
Mm-hmm. Okay, Adrian, let me get to brass tacks now. What are you betting on India, your overall argument that you don't see too much earnings growth since real interest rates are high. But nevertheless, what will you pick at this juncture?
Look, I'm a little bit conservative on India for the next quarter. As I highlighted earlier, real rates are high. I think Indian earnings and growth rates will disappoint. Credit costs will continue to move higher. So we're sitting with a relatively narrow, high-quality portfolio rather than, a broad bullish view on the Indian market. Our view would change if we were to get some guidance that the Reserve Bank was going to start a more meaningful easing cycle. I think it's also a call of sort of relative stories. There is extreme valuations in terms of being cheap in places like Taiwan. You can buy Taiwan tech at 2 standard deviations cheap. We've got a shareholder value story emerging in Korea. That market is certainly cheap on a PE basis. And I think the risk premiums around China are very elevated, and those will come down gradually as we get comfortable with the new economy in China. We get comfortable with the debt structure, with the type of QE that the PBOC is undertaking. And I think we'll get a bit more comfortable that the renminbi is not fixed to the US dollar, that it moves a bit like other emerging market currencies. And that's where I'm recommending people focus. If they have a position in India, it's a neutral position with a high quality bias.
So if I were to ask you, for an Indian long-term patient investor, does it still make sense to stay with the leaders of the previous run, the likes of the banks, autos and pharmaceutical names? Or now at this point, with a 3 to 4 year horizon in mind, would it make sense to even look at some of the bombed out sectors that people don't want to own, names like metals or infrastructure?
I think it's a mistake to go into metals, into steel. It's also a mistake to go into the infrastructure engineering companies at this point in time. There is CapEx going on from the public sector. At the moment, it's primarily in roads. We will begin to see an increasing number of announcements on railway projects, which look very good, and this is well beyond, a high-speed train between Mumbai and Ahmedabad. These are metro schemes, and I think what you do there is you play them very indirectly via the cement, the building material space. The issues that we have with sort of engineering and construction is that you have exposure to energy capex, you have exposure to the Middle East, which is fiscally very challenged. And you're also, as I highlighted earlier, in an environment of high real rates, the corporate sector is unlikely to be picking up capex anytime soon.
Okay, we have about a minute and a half, but yeah, I can squeeze in a bank question to you. Would you buy any of the banks? Would you say that most of the problems now are at least known?
Look, I think if we have, another quarter of high real rates, that will continue to be an environment where you will see more distressed assets, and an environment where loan growth will disappoint. So be very careful with the banks for now. Stay with, the top players, the higher quality names.
Okay, and there are some fresh slew of problems coming for the automobile companies because of environment concerns. As a whole and individually, where do you stand?
Yeah, actually, I actually think that's rather counterproductive what Delhi announced. Look, Delhi's full of a load of old polluting vehicles. I think it would be much better to get those off the road and buy new vehicles, but whatever, that's what they've decided to do. I am a structural bear on the auto industry. The internal combustion engine is likely to be phased out over the next 10 years. The setup that the auto companies have at the moment, I think, are going to be very challenged. And as we saw with the climate agreements in Paris, India cannot afford to develop a car density similar to even a middle-income country using the internal combustion engine. There's just not enough oxygen in the country to...
Headed by the end of 2016, because at the start of 2015, a lot of people predicted 30,000 plus for the Sensex by December, and here we are at 25,000. What's your own crystal ball telling you?
Look, I think if we get an environment in which the RBI begins to cut interest rates, maybe some point in the second quarter, you get a more fiscally effective government as these projects start to get executed, then India should perform very well. And I'd be very comfortable with India giving a 15% plus return over 2016. That would be consistent with, we should get mid-teen earnings growth. And I think there's also a possibility that maybe valuations could move a bit higher if we do enter into an easing cycle.
Okay, so your bets would be defensive bets. Would they be IT, pharma?
Well, remember, my previous answers about the sort of near-term cautiousness.
Yes.
So for now, we're running a high-quality defensive portfolio. I think that would change if you got a change in RBI policy.
All right, Adrian Mowat, pleasure speaking with you. Thank you very much for joining us, and hope
Merry
you
Christmas,
personally have a great 2016. All right, so that's